how to select the right mutual fund. This is exactly what you are going to discuss in this video. By the end of next 5 steps, you will be able to identify set of mutual funds for yourself for wealth creation. My name is Janak and I am from the content team of Kotak Cherry, and let me take you through this. In investing and in life in general, before commencing anything, the first thing that you should do is to know yourself, and this is true about mutual fund investments as well. Why exactly are you investing money in first place? This is the first set of questions that you should ask yourself. Apart from this, what exactly is your investment horizon? 5 months or 5 years? If you are looking to purchase a car in next 12 months, equity mutual funds might not be your best option. But if you are planning for your children's wedding, which is 20 years away, your risk tolerance changes significantly. In fact, we are going to talk about risk tolerance shortly ahead in this video. But the larger point over here is, in the short run, equities are very volatile, and hybrid and debt options in the short run can provide that cushion. However, this game changes completely as your outlook becomes more and more long term. Few minutes ago, we spoke about risk tolerance. Let us simplify this. Let me ask a question to you over here. Are you someone who panics when your portfolio goes down more than 20%? Or are you someone who is calm about it? If you do not turn uncomfortable seeing your portfolio in red and have a long-term outlook, then your risk tolerance is on higher side. However, if the case is opposite, then your risk tolerance is on the lower side. Also, it is important to keep in mind your age and the number of dependents that you have play a factor in defining your risk tolerance. Young person in their 20s who has recently started earning will have a very different risk capacity from somebody who is just about to retire or maybe has college going kids who are dependent on them. If your risk tolerance is on the higher side, you can look at blend of large, mid or even flexi cap. But in case your risk tolerance is on the lower side, there are hybrid or debt funds that you can look at. Remember friends, personal finance is called personal for a reason. And if you found this example very simple to understand, don't forget to subscribe to our Kotak Cherry channel. Now, in this section, let us get into mutual fund specific stuff. For sake of simplicity, let us assume you like certain category of fund, say large cap funds. Now, these funds will have a fund manager running them. They will incur certain expenses, administration expenses, marketing expenses, fund manager's salary. All this is borne by the investors in the fund. This metric is best tracked by something called as expense ratio. Say for example, in fund A, the expense ratio is 2%. It means that out of 100 rupees in the fund, they are investing 98 rupees. So typically, rule of the thumb says lower the expense ratio, the better it is. But over here it is again very important to ensure that you don't compare from different segments. Expense ratio for debt, small and large cap can be very different. Please ensure over here you compare apple to apple. Hope you are liking the discussion so far. With that thought, let us take this discussion one step further and look at the importance of something called as AUM or asset under management. In very simple terms, asset under management simply represents the total amount or the pool of funds that a fund house is managing. While high AUM doesn't guarantee higher returns and lower AUM doesn't mean non-performance, it simply means that if AUM is on the higher side, it goes on to show that large number of investors have faith or confidence in that fund. Funds with lesser AUM might face the issues of liquidity, and as an investor, this is something we should look to avoid. Also, it is important to note over here is that as the AUM goes up, the expenses tend to go down, meaning a better expense ratio. And this is exactly what we discussed just few minutes ago. At the end, what is that one metric which is of supreme importance to any investor? Performance. But wait, historical performance doesn't necessarily guarantee future performance. But nonetheless, important point to note over here is it can act as a very good guiding pointer for evaluating a certain mutual fund. If you are investing in an actively managed fund, a fund which is not tracking any underlying indices such as Nifty or Sensex, a fund where the fund manager manages actively the portfolio, the first thing you should check over here is the performance of the fund against the relevant benchmark index. If the mutual fund is delivering better returns than the index and that too consistently, then thumbs up, hit the like button. But if that is not the case, one is better off looking at either index or passive funds which tracks Nifty or Sensex or any other relevant indexes. Consistency is also something to watch out for here. Say for example, in a certain 5-year period, Nifty is delivering returns at 10% CAGR. But if the fund under consideration is delivering say 5%, 15%, minus 25%, minus 5%, then as an investor, this can give you sleepless nights. These pointers doesn't mean that all active funds are bad, just evaluate them carefully. Also ensure comparison from the same category. That is, you compare say for example an ELSS against an ELSS itself and then only cherry pick. Along with active and passive, there is an option of asset allocation or balanced funds as well. These funds simply use the mix of equity and debt as per the market situations. Remember, diversification is important here as well. Just for the sake of hypothesis, you have found the best fund. Even then, don't put all your eggs in one basket. Create a basket of 3-4 mutual funds and diversify appropriately. By the way, investors in tech mutual fund have been very worried of late due to underlying correction in tech stocks. So as an investor, you must definitely check this video out, which is on the topic of why these tech stocks are undergoing correction and one secret for investing.